Today's CPI report was another win for markets. We see the expectation was 2.4%, and we actually got 2.3% inflation year over year, confirming for a third straight month that inflation is actually cooling. And we can see the NASDAQ is taking off here today in response to this. Same with the S&P 500, and both are now confidently over their 200-day moving average, showing strength is back in bull territory. Meanwhile, as you might expect, a soft inflation print has caused the US dollar to give back some of its gains from yesterday, as a softer inflation print suggests that the Fed may actually have the ability to cut interest rates in the upcoming meetings. In fact, looking at the June meeting, which was largely expected to not be a interest rate cut move from the Fed, we do now see that the probabilities have slightly ticked higher for a 25 basis point cut. Looking out to July, you can see that now the market is thinking that there's about a 40% chance that we do get a rate cut in the July meeting. And going out to September, we see a very strong probability that we do have our first or potentially even our second interest rate cut from the Fed. In other news, we see that Microsoft is cutting nearly 3% of its global workforce, about 6,000 jobs in its latest push for efficiency. And Trump is also expected to speak after the White House announced a $600 billion Saudi Arabian investment into the United States. While an investment was expected, having this in kind of writing, if you will, is a strong investment into the United States. Additionally, Elon Musk says that Starlink was approved in Saudi Arabia. And as we continue to see cooling inflation data out of the United States, down to 2.3% is a great point of progress in terms of where we were several years ago. On the outbreak of COVID, we saw the reaction of markets seeing almost a 10% inflation rate in the United States. Now we're down to just 2.3%. So while prices are still rising, they're doing so at a much more stable rate compared to a 10% inflation rate where everybody going to the grocery store was having a panic attack in aisle 4. So again, the response here from the US dollar is a move lower in terms of, from this kind of inflation print. We do see that down to the 15-minute chart. You could see as soon as we had that inflation print come in soft, the US dollar has been pushing lower since. And while this is a weakness for the US dollar, you might expect that gold would be up significantly today. But because of all of the trade deals and things that have been going on to soothe markets a bit, gold has lost its luster, at least in the short run, with prices coming down from their highs of around 3,500 down to where they currently sit at around 3,250. In terms of gold, I remain neutral on this one, and I really don't see a strong reason to be bullish or bearish at this time, and really think that in terms of price action, we probably would just most likely stay in a range-bound state, at least for some time. Perhaps we've put behind us the continuous uptrend in gold, and maybe markets are going to simply digest the new landscape that we see ourselves in with trade deals taking place and at least backing off the brink of a cliff when it came to the trade wars that people were worried about, with the Chinese and the United States signing a 90-day pause, with the US imposing a 30% tariff on goods coming into the United States, and China imposing a 10% tariff on goods going into China from the US. And again, it does seem like while trade stuff still needs to be negotiated, the worst of us, that doomsday fear, which drove gold partially up to this all-time high, may now be behind us. So it makes sense that gold has cooled off since that point. Speaking of cooling off, we do see a really strong rally kicking up here for the NASDAQ especially. From the lows here, guys, in just a few short weeks, we have seen almost a 30% rally in stocks, which is an incredible bounce back. Granted, a lot of the concerns here were considered self-inflicted by many market analysts because, of course, the U.S. came in with their new administration and said, hey, we're changing everything on trade. And then we've, of course, seen the sharp bounce back here recently as some of those quote-unquote self-imposed wounds have now been chosen to be healed, right? And that was the thing with tariffs from the beginning. The challenging thing about tariffs is that can they cause serious changes in trade dynamics that could send us in a recession? Yes, but at the stroke of a pen, things can be changed, deals can be signed, and that can be taken away. And that seems to kind of be what the market is now really excited about. My personal view on the markets is that pullbacks are opportunities to be bought for my own trading and my trading strategy. Of course, not financial advice as always on this channel. But I do still see, if we go over here to our top setups within the Edge Finder, that the indices, the NASDAQ, the S&P, the Dow Jones are all getting strong bullish opportunities here in terms of of a bias based on the sentiment, technical, and economic data scans that our software automatically pulls in. And take a look at the put to call ratio, still in neutral territory. And on Wednesday night, we'll get the latest reading in terms of the AAII Investor Sentiment Survey. I'm very curious to see if this data comes in equally bearish or if people start to capitulate and recognize that perhaps the worst is behind us and start to feel a little bit more confident about stocks. And I do want to add, of course, something could change. Something could get ugly again. But right now, there has been some serious progress, and yet we still see sentiment very ugly out there. And just as a reminder, sentiment has been dead wrong. So when the whole crowd is worried about something, falling apart, just be cautious that you're not chasing everyone off a bridge. The Bitcoin to gold ratio continues to charge higher, suggesting that risk on is still in play at this time. We went from gold significantly outperforming Bitcoin to now Bitcoin outperforming gold. Speaking of Bitcoin, you can see this chart has been very, very strong, and any pullbacks on this one are also an opportunity in my perspective to potentially get long and continue to ride this higher if it wants to do so. And with the soft inflation print, we do see a bit of a bounce back here in the euro today. However, this is kind of in no man's land with some strong economic data points like PMIs coming out for the United States here recently, as well as trade deals getting announced. I'm pretty neutral on the dollar because yes, we had some cool inflation prints, and yes, we also see some other job weakness and things like that. So if I pull up our economic heat map, you can pretty much see that we have a mixed view in terms of the US dollar. You have some things that are suggesting bullishness for the US dollar and other things that are suggesting bearishness, like CPI, which is a softening point, or GDP, which came in soft as well. Or you take a look at wage growth, or you look at JOLTS job openings. But again, before you can get too overly bearish about the US dollar, you have to also acknowledge that the jobs print was strong, that the jobless claims are still healthy. And we also, like I said, had PMI data that came in strong. So this is where I say when you're trying to be a fundamentalist, you want to make sure that you have a conclusive and kind of full view of what that market is telling you, rather than just looking at one thing, right? We don't want to just look at the jobs report or just look at unemployment rate. We want to look at conclusively a bit of everything. Taking a look at our economic surprise meter, these would be countries that are outperforming expectations the most or underperforming expectations the most. In the middle ground, you have things like the US and Canada. And when we take a look at some of our strongest performers, you have New Zealand, Australia, the British pound, and the Swiss franc. All of these ones are producing some better than expected numbers in terms of their economic forecasts. And the weakest of the group at this time is the Japanese yen. And what we can see here is when we take our strongest currency versus our weakest currency in terms of economic surprise, it's no coincidence that the pound is driving higher. As we know, fundamental analysis is what drives the markets in the particular direction. Specifically looking at the British pound against the Japanese yen, we are breaking out, it looks like, of a key resistance point at 195. Another popular currency pair is the dollar yen, which does actually have a bullish reading on the edge finder and is also a chart that I was looking at for a bearish perspective for some time and now actually looking for a possible bullish setup on this chart. Things have pretty significantly changed for the Bank of Japan in recent times. You can see our Japanese economic heat map has suggested a little bit more indication towards bearishness for the yen as opposed to stronger currencies out there, like New Zealand, which has a very strong currency score overall based on the economic data. Looking at the chart for NZD-JPY, we're breaking out of a key level around 87. If we get some sort of move like this, I may actually look to re-enter this trade. I actually closed out of a trade on this one for a profit, probably a little bit too early, but I am looking to rejoin the trade if we either break and retest here or come back into this area. Both look like opportunities for me in my own trading strategy to get long as the fundamentals still support upside. Another chart that I'm watching is US oil. US oil is getting a bullish reading. Let's check that one out. So oil's had a pretty impressive turnaround. Taking a look at this in recent times, you can see it looks like we may have double bottomed here on this 56 level of support. And what I'm curious to see is if we actually can break through this 64 level. Doing something like this would actually be a strong indication that maybe we have further upside in the short run. I do think that oil is probably in the phase of a longer term bottoming out point, then moving much lower than current levels, simply because if we do break massively lower, it would suggest to me that likely the scenario is that the world is entering some sort of recession, which is what people were fearful of when this thing tanked back in April. And did you know that the Edge Finder is completely free if you sign up and follow certain criteria with 8cap? There's a link in the description down below, or you can head over to a1trading.com/8cap to find out how you can get access to the Edge Finder 100% free if you meet certain deposit criteria. Please note this is available only to traders outside of the United States who can qualify to sign up and create and deposit into an 8cap account. If you reach certain deposit tiers, you can get access to the Edge Finder completely for free, and all of the instructions can be found on A1 Trading's website, a1trading.com/8cap. That's a1trading.com/8cap. Guys, 5 years. Can anybody else believe that? It's been 5 years since COVID-19, and we are still picking up the pieces, and we're still working back inflation. Inflation was below 2% before COVID. COVID really, people have their speculations, their conspiracies, all of this stuff about COVID. But what we can all agree on is it caused some serious challenges for everyone. And with COVID, there was some serious challenges in monetary policy, because what do you do if the supply line, let's just take for example, everybody may be familiar, a lot of my US friends specifically may be aware of like the price of eggs going crazy due to some supply issues, right? I don't know very much about this topic, but I know that there was like something that seriously disrupted the supply of eggs in the United States. I don't know if it was other places too. I imagine it probably was. So the supply, it's basic supply and demand, right? And I took one of the biggest regrets in my college years was that I took microeconomics instead of macroeconomics. And like, it was one of my electives I chose because I was in computer science, so I didn't really get to do a whole lot of economic stuff. And that's not my my academic background at all. Economics has been something that I've learned on the streets, if you will. But my background was in software engineering, and I could take an elective, and I wanted to take some sort of economics. And I chose to do microeconomics, which was still useful and still cool. But I always regret, dang, I wish I took macro, because it would be way more, not that I haven't learned a lot of the same stuff nowadays, but I would have enjoyed that class more, I think, based on, what I do today. Anyways, so here's the thing. In supply and demand, basic stuff. If you have declining supply, what does that do to the existing demand? Any other economics majors who are way more, intelligent than I am will know that you've seen this chart 7,396 times. And that's what that chart looks like it's a basic concept. So in COVID, we had massive cuts to supply because workers were sent home, ships stopped shipping, trucks stopped trucking, supply line issues were everywhere. And so what did that do to the demand for existing goods? Skyrocketed stuff, and prices went up. It was made, and I say this lightly because people needed, the money printing that gone on. I'm not here to dispute. We printed a ton of money to try and help people in that situation as well. And again, we probably should have helped a lot of people. But the point is, a tough situation was also stoked a little bit by printing a lot of money to, in theory, help people. And like I said, I think a lot of people did need that help. But a lot of people also took that and bought NFTs and Bitcoin and golf clubs, and they partied, they took a trip. So anyways, the stimulus checks, were they all used for essential needs? I'm not judging, but I'm pretty sure most people did not use it for that. But anyways, a lot of people did, and they needed that. But here's the thing. Not the point. The point is, inflation was made to be a very, very prolonged and challenging problem. And so here we are at 2.3%. We went up to like almost 10%, 10% down to 2.3%. I do think that given such a challenging environment, the Fed has done a relatively good job. In my opinion, is that they should be left to finish what they've started. We're getting closer. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.